Most NNN investors think they understand cap rates. They don't. And that misunderstanding is costing them hundreds of thousands of dollars on deals they think are good. I'm going to fix that right now. In the next few minutes, you're going to understand cap rates the way a real broker does, not from a textbook, from real deals. You'll know how to calculate them, what actually drives them, and how to evaluate any NNN deal before you make a mistake. I've closed over $225 billion in NNN transactions. This is exactly how I look at every deal. Let's get into it. Here's the truth most people miss. Cap rate is not just a return number. It's a risk signal. Every time you see a cap rate, the market is telling you how risky that deal is. Higher cap rate, more risk; lower cap rate, more stability. So when someone says, this is a great 7% cap, my first question is, why? Because the number alone means nothing. Now let's simplify the math. Cap rate equals net operating income divided by purchase price. That's it. In NNN deals, it's even easier because the tenant pays almost everything. So your NOI is basically your rent. Let's say you have a Dollar General doing $100,000 a year and the price is $1.5 million. That's about a 6.67 cap rate. Flip it the other way. If someone gives you the cap rate and rent, you can back into the price in seconds. That's how you spot bad deals fast. Now, here's what actually moves cap rates. First, tenant credit. This is everything. A Walgreens, McDonald's, AutoZone, that's corporate backed income, lower risk, lower cap rate. A smaller operator, higher risk, higher cap rate, and that spread can be massive. Second, lease term, 20 years left. That's stability. 3 years left. That's a problem waiting to happen. Short lease equals higher risk and higher cap rate. Third, location. Same tenant. Completely different outcome depending on where it is. Real estate still matters, always. Fourth, rent bumps. If your income is growing over time, that deal is more valuable. If it's flat, you're losing to inflation. Fifth, interest rates. Cap rates don't live in isolation. They move with the market. When rates go up, cap rates go up. So what's a good cap rate right now? Here's reality. Investment grade tenants, roughly 4.75% to 5.75%. Non-investment grade, 6% to 8%, sometimes higher. And if you're seeing something above that, you need to ask yourself, what's wrong with this deal? Now, let me be blunt. This is where investors lose money. Mistake number one, chasing high cap rates. An 8 cap doesn't mean a good deal. It usually means there's a problem. Mistake number two, ignoring lease term. Short lease, you're not buying income. You're buying uncertainty. Mistake number three, ignoring tenant quality. That great return disappears the second that tenant stops paying. So here's how I evaluate any deal. Simple: tenant, lease, location, cap rate versus market, exit strategy. If all five make sense, now we're talking. If one doesn't, you better know exactly why before moving forward. If you got value from this, hit subscribe. We break down real NNN deals every week so you don't make expensive mistakes. And when you're ready to actually look at deals, go to nnworld.com. That's where you'll see real opportunities in the market. And if you want to move faster, check out letstransact.ai, built to help you analyze and close deals smarter. I'm Ted Dowding, and as always, let's transact.